We want to thank Asofundos for the opportunity to speak today. I just learned before coming onto the stage that we are the last session before lunch. So we will try to keep this brief so that you all can enjoy your lunch and time networking. We want to thank our limited partners in Colombia and throughout Latin America, which includes pension funds, insurance companies, family offices, and individuals. We're all honored, Jameson and I, to call you our partners and to have the great privilege and responsibility of investing your money on behalf of your constituents. We are very excited to participate in Asofundos. This is a sign of Blackstone's commitment to Colombia and Latin America. We've been down in Colombia and Latin America partnering with our investors for over 15 years. And we hope to meet many of you today and have the opportunity to partner with some of you in the future. My name is Mike Lynch. I'm a managing director at Blackstone. I've been at the firm for about a year, and I'm responsible for building our relationships with our partners here in Colombia and throughout Latin America. I'm based in our New York headquarters office, and I spend about half of my time in South America. At Blackstone, I'm responsible for leading our relationships with institutional investors in Colombia and throughout South America. This consists of building long-term relationships with chief investment officers, some of whom I see in the audience today, heads of alternatives and private equity, at pension funds and insurance companies. We market our private equity strategy specifically, and then we work with our limited partners to make sure that we achieve the goals that they're looking for in our investments. This could include fund investments, co-investments, and knowledge sharing. Today I'm joined by Jameson Motis for a discussion about secondaries private equity investing with a focus on opportunities and risks in today's environment, which I think we can all agree is a volatile one if anyone is checking their phone and the stock market today. Jameson is a senior managing director at Blackstone, and he's the chief investment officer of private equity strategies for Strategic Partners. Strategic Partners is Blackstone's $82 billion secondaries business that's comprised of LP-led secondaries, GP-led secondaries, and GP stakes, which are minority equity positions in other managers. Jameson joined Strategic Partners in 2006. So he's been with the strategy for almost 20 years, and he's very knowledgeable in the secondaries market. He sits on the investment committee for all the funds associated with Strategic Partners, and he's responsible for leading a large team at Blackstone of 145 investment professionals who are only focused on secondaries, so it's a very big team. Jameson is a graduate of the New York University Stern School of Business, where he studied finance and economics, and he graduated with honors. But perhaps most importantly for this room, Jameson married a woman from South America. His wife is Argentinian, and he has 2 young children. So Jameson, welcome. Let's start with a brief introduction of yourself and Strategic Partners.
Firstly, muy buenas tardes to everyone here. Gracias por recibirme aquí en la hermosa ciudad de Cartagena. So, mildly better than Mike, but not much better. So I have, like Mike mentioned, been with the Strategic Partners team for going on 19 years. We have been in the secondary private equity business for about 25 years. So started in the year 2000. We were started at once was a very big place, but now doesn't exist, Credit Suisse. And we were there for the first half of my career. And a little over a decade ago, our team and our business was sold to Blackstone, which has been a very happy marriage ever since. And what we do all day and every day is secondary private equity. And we can touch on, why it's very interesting to be a seller in this market, why it's interesting to be a buyer, and how this strategy makes sense kind of irrespective of a lot of the ups and downs that we're, like Mike mentioned, we're seeing on our phone today.
Great. Well, why don't we start there? From our understanding of the conference today, the pension funds and the investors in this room have a large allocation to alternatives. There's impending regulation, many of which is uncertain in terms of how that will affect portfolios and portfolio construction. Let's start with just the setup on a secondaries transaction around why would someone sell and how does the transaction actually work from a buying perspective?
Great. So everyone here, or most people here, have committed to private equity funds. And the typical deal is it's a 10-year commitment where the general partner is investing over the first 5 years, and the next 5 years they're sending you capital back as they liquidate the companies and assets that sit within the portfolios. But there are many reasons why, during that 10-year commitment, sellers may want to sell. It could be a new chief investment officer who wants to reorient the strategy. There could be an element of locking in gains. There is an element of cutting losses. Oftentimes, people see their teams grow at a much slower rate than the size of their portfolios. So there is just a general portfolio management aspect of the name of groups that you're working with is expanding, it's not winding down, and you need to reorientate to the groups that you're very excited with and want to keep investing, and selling out of groups that you're no longer committing with. So there's a whole host of reasons as to why people sell. And then on the other side is, why is it interesting to be a buyer in secondaries? So as people are selling, we are generally buying in at a discount. And that discount is often, quite meaningful. And you can read all the different reports that are out there. But, historically, it can be near 20% type levels. And when you come into a fund later in life, you're avoiding all the fees and expenses that were associated with the early years, where it was a relatively high load, but little in the way of assets. And then you also have a lot more visibility when you're buying into a fund 5, 6, 7 years after its start date, where you might miss out on a number of the winners, but you also miss out on a lot of the losers in a portfolio. And you have a good sense as to what's performing and what is not performing and what is on plan and is within the strategy of the general partner and what is doing the opposite. And you can use all that information to underwrite the go-forward levels.
Got it. That makes a lot of sense. And how would you characterize the current market environment for secondaries investing? And you've been around for 20 years doing this. How has that changed over time?
So when I started, the secondary market was very small. So in 2006, it was about a $10 billion a year market. So very, very tiny. I remember, and I didn't know much about secondaries when I joined my group, but I remember talking to friends who were working at other parts of the bank, and they were working on deals that were $10 billion, just one deal. So it was, and that was the entire market with dozens and dozens of participants. Today the market's $160 billion. So it has grown pretty tremendously over the last couple of decades. And that growth should only continue, and should only continue at a very significant rate. The current dynamics are ripe for the record levels that we've seen to be topped. So last year was a record year at 160. This year will be another record year in terms of volumes for private equity sales. And the reasons for that are a lot of the obvious things that you're probably seeing in your portfolio. There are more investors in private equity. People have committed more percentages of their portfolio to private equity. And in many instances, distributions are significantly down from what they were historically and what people expected. And if you're not getting liquidity naturally, you may have to look to the secondary market to generate your own liquidity.
Got it. And so within that, you mentioned a couple of them, but what are the major drivers of secondary volume? And I just to clarify, you said 160. That's $160 billion of secondary volume sales in a year, correct?
So we touched on it a little bit in terms of new management for LPs, where people are locking in gains, reorienting their portfolios to groups that they want to invest more with, and selling groups that they do not want to continue to invest with. When you look at the fundraising environment, it has been very challenging for many groups that are raising private equity funds. And many managers that have historically had little issue raising money have been in a period where it's been challenging or it's just been taking longer. And LPs are watching that dynamic, and if they do not have the capital, they will shy away from groups that make less sense. They will double down on groups that they want to have a bigger relationship with. And then in the middle, it's, maybe I will sell and use that capital for other things. And whether that's for other parts of the portfolio, whether it's managing different exposures across asset classes, or it's simply, I think the go-forward return with these private equity assets is X, and I can invest with someone else, and I think the return is going to be Y. Maybe I should sell here and invest here.
Got it. Thank you. And I guess volatility is on everyone's mind as we see the various things that are playing out in the world. Let's pivot now to talk about the opportunity, as this panel is focused on opportunities and risks. Where do you see opportunities right now in secondaries investing? Where are you and your team spending time? And how does the volatility overlay either help or hurt those opportunities?
Volatility is good for the secondary market in general, for a number of reasons. It's very helpful as a buyer because people are going through more issues and are more likely to accept a bigger discount. And it just drives people to make more active portfolio management decisions. And the good thing about being a buyer on the secondary side is if you look at an original investor, they could be 7 or 8 years into an investment and looking at where liquidity is and where they think it's going for a particular asset. That's obviously a much different place than us or other secondary groups that will be coming in at that 7 or 8 year period. And this year could be a tougher year. Beginning of next year could be a tougher year, but we still have a much longer runway, and we're comfortable underwriting what could be a longer hold period for assets in a more choppy market like we are seeing today.
And within secondaries specifically, are there any areas of focus, whether they be geographies or types of underlying strategies, buyout, growth, venture, or any other setup dynamics when it comes to a transaction that you're especially focused on and will be focused on now with this increased volatility?
Generally speaking, in a market like this, most investors, including us, are going to focus more on buying into portfolios that have multiple exit options. So the world is probably going to move a little bit more down market on the secondary buyer side. And if you just think about that, it's a lot easier to exit a company that can be sold to another private equity sponsor or can be sold to a strategic corporate acquirer and, maybe in the upside chance go public versus looking at portfolios where everything needs to go public. And there is a very long line for assets, in the US and in Europe and all over the world to access those public markets, and which just means it's going to be a longer hold period. And when you think about like what secondary funds try to deliver, it is a rapid deployment of capital. So they try to put the money to work over, a shorter time frame than most private equity. So think 3 to 4 years instead of 5 years. And also the capital comes back quicker. And the goal is to have capital back in like 3 years as well versus 5, 6 years. And if you are looking at businesses that only have one exit option, it's a bit more challenging. And if you look at venture and growth, a lot of those assets are in a similar place to larger private equity businesses where they also need to access the public markets. So I think there will be a bit of a shift in terms of what sellers are selling because they want to sell things that will get better pricing in a more challenged market. And then buyers will target assets that make more sense given the circumstances around liquidity.
Got it. So sounds like there's a definite move in terms of moving down market to be able to capitalize on those multiple exit options. I guess the flip side of that is, will you be now avoiding larger deals, or are there other areas of the market that you plan to avoid?
And I think the one nuance for secondary private equity is it could be a very large secondary deal, but it could have lots of funds, which have lots of companies, which are not large. And then there could be a small secondary deal where you're buying one interest in, one mega cap or large cap fund, which has large companies. So the size of the secondary deal doesn't necessarily relate to the size of the underlying general partners and their funds and their companies. So that's all to say that deals can come in all different shapes and sizes, but the real focus is on the underlying businesses and how those businesses are performing, what their leverage levels look like. Obviously, you need to underwrite all of the supply chain issues that will be coming through with yesterday's announcements, and then going back into what does the liquidity profile look for businesses.
That makes sense. And do most secondary buyers use sort of a bottoms-up approach where they're looking at those individual companies and individual funds?
It depends. I can speak for ourselves. We're very focused on looking at underlying businesses and modeling each individual business and then building up to what the cash flows look like for a portfolio. Others could take a more top-down approach, which we try to avoid, where you're getting projections from underlying managers and you're discounting those and delaying those and running sensitivities around that. So it's a different way of looking at the market, and it's really, how much work do you want to do?
Right. Great. So we have about 5 minutes left. So let's pivot now from the market and where we're seeing opportunities to look into the future. And I know that we don't have a crystal ball. Not even Blackstone has a crystal ball. But in your view, where are the real opportunities as you look to finish investing the current fund and as you raise your next fund? Will it be more of the same, or do you expect to make significant changes in either the type of investment that you're doing or the structure?
Yeah, generally speaking, as you move into a market like the one that we have today, the bottoms-up approach matters even more when you look at and think about underlying businesses. But the good news from a buyer's perspective for us and others is that there has been a lot of capital raised for secondaries, but certainly not enough to absorb the sorts of increases in selling volume that we expect. And we expect the number and types of sellers to only increase as we move into the middle and back half of this year, and especially as we move into next year. And there are still many groups who have thought about selling secondary or selling their portfolio in the secondary market, but haven't transacted yet. So there's a tremendous opportunity in, first-time sellers. If you look at private equity commitments, only about 2% ever turn over in the secondary market, which is very tiny. Every other asset class is, multiples and multiples of that. Many assets, turn over well over 100%. So there is a huge inventory that, only a small change would be dramatic in terms of market volumes. If 2%, went to 3%, that's a 50% increase there. And then you just look at all the investors who probably overcommitted in the 2020, 2021 timeframe. And as those portfolios mature, we'll look, at what it will be year 5 for many of those portfolios to sell them next year or the year after and into the future.
Great. And last question here. Many of the investors in the room have commitments to alternatives. They may be considering secondaries, particularly as the regulations change and they gain more clarity around what the asset allocations will be, whether there's a move from the risk fund to the target date fund. What advice do you have for the investors in the room who are thinking about either selling their own positions or investing in secondary strategies?
Sure. I guess a few points. And I'm very biased. I've been working in secondaries for my whole life, so I am obviously part of that cult, so to speak. As it relates to selling, if you have to sell in the secondary market, the biggest mistake I see sellers when we're on the other side of the table or when other groups are on the other side of the table from sellers is people tend to get hung up on the discount that they're selling for versus what would be my go-forward return for these assets versus what can I do with that capital when I receive it. So people tend to get more emotional about the price versus thinking about go-forward returns and obviously ignoring some of the fixed costs that they've had to bear. And that's just general psychology, and that applies to whether you're selling private equity or if you're selling the car that's in your driveway. In terms of the benefits of secondaries in a market like today, you're obviously benefiting from the stress in the system and the ability to buy things at a discount and the ability to buy big diversified portfolios where you're getting, dozens of funds and hundreds of assets, and you're able to buy in when they are more mature, so you should have liquidity back. So it's a nice opportunity where you are capitalizing on many market dynamics, but you're also benefiting from diversity across company and partner and vintage year of underlying assets that is tough or impossible to replicate if you were just going to invest today.
Great. Well, it sounds like there's a lot of opportunities in the secondaries market today for both buyers and sellers, and we thank you for sharing your insights with us today.
Thank you very much.